student entrepreneur here, Nathaniel Stevens, and he's the CEO of NatPal. I don't want to steal his thunder by giving a bio introduction because that's sort of part of the gig out here. So the way this presentation is structured is that, so Nathaniel is going to present like he's presenting to a VC to raise money. It'll be around 20-25 minutes, one of which Doug will have, I would say, around 15 minutes or so of questions, just one-on-one Q&A. And after that, we'll open the floor to questions for Doug and Nathaniel from the audience. So we'll get started. And so we have a pretty large problem. We have traditional advertisers, local businesses who have really used and relied on Yellow Page and newspaper advertising to draw consumers to their business. Fortunately for me, unfortunately for Yellow Pages, usage has really stalled in these mediums. And as a result, there's a huge opportunity for local businesses. There's one problem: they can't tap into this online space and connect with the thousands of searchers who are online looking for local information, local commercially oriented information. They don't have the resources, the time, or the money to do so. The web and search advertising is quite complex and requires continual maintenance. And it's just either too painful to manage or they're just avoiding it altogether. So, NatPal's solution is to develop technology that completely automates the advertising function in the SMB's quest to acquire more customers. This is not a small market. The Kelsey Group, a major research organization, predicts this to be a $10 billion market by 2010. One of the main problems is that we have, this is Excite, a medium-sized search directory. Most of the traffic is in the tail of the search, which is very hard to exploit, bundle up, and monetize. What our technology will do is work with SMBs and localized service-oriented businesses and allow them to connect to these, which is in aggregate over 97% of all search traffic. As I said, the local ad market really is experiencing a paradigm shift here. It's got about $100 billion market, and the main staples again are newspapers and Yellow Pages. What our system does is really automate campaign setup, analysis, and refinement of the campaign, centralizes ad distribution platforms by working with web services through an API that Google has provided, Yahoo has provided, and major other search engines.
You're up and running. You're generating revenue now. It's something about half a million run rate.
Yeah, we're up and running. Have had great customer adoption. We're about up to a $500,000 run rate.
Are you focusing in any way? Are you focusing geographically or by category?
So we focused on about 5 to 10 industry, your traditional professionals, tradesmen, autos, real estate, really localized, regionally specific businesses.
Focusing on the Philadelphia area.
Philadelphia, and now we've grown into the DC market as well, and are having great penetration there as well.
It's transferring.
Yeah,
As expected.
exactly.
And I assume you've identified, some number of key metrics around the segment that you're tracking to see if it works or not.
Right, in terms of the results for the customer or for our individual penetration.
Just margins,
Yeah, we're managing our margins pretty tightly. Really looking at how deep we can go into a certain vertical, and yeah, we've had basically the way the sales team goes out is they focus on one vertical at a time and just drill down that vertical, but are in a geographically specific area. So, really, what AdStation does, and the main impediment from small businesses getting online is that there's too much risk and it's too time-consuming. What AdStation does is allow them to pay for performance online. What we're using is what we call a pay-per-call or pay-per-click platform. For the local SMG, the pay-per-call has been a great selling point, where how this works is they're only paying when we actually generate a phone call to their business. We're working with some phone providers to actually track that, record that, and then monetize it. So this alleviates a substantial amount of risk of traditional A, traditional advertising, and B, search advertising. The way AdStation works is essentially advertiser logs on, enters his industry, his geography, his ad text. Ads are placed on the major online properties programmatically. Users search, and about 5 to 15% of these users will go to the client's website. We're tracking the whole process from what they searched for what they do when they get to the website, if they made a phone call, if they submitted an email lead, etc. And that data that we're gathering on these industry-specific industry verticals and clients enables us, as we'll see in a second, to really provide them with measurable results and a superior return on investment.
Okay, so walk me through a customer, so some dental office in Philadelphia. Take me through sort of the whole process.
So a dental office in Philadelphia will work with us. The first question we would ask is, A, do you have a website, or are you new to the web entirely? If you're new to the web, we basically we have a pre-designed industry template that we'll use, enter in your content, and then post that online, and then drive traffic to it. And then on the back end, they'll basically receive phone calls and get a monthly report at the end of the
Pay you what per phone call?
Yeah, they're paying us on a per phone call or a per click basis.
But you're buying the keywords.
Right, so through our system, they enter their budget, and that basically determines how many phone calls or how many clicks they'll actually receive.
And then you're distributing that. So for, say, a dentist, you have some IP around search words at work.
Exactly.
And so you've got a cost per call, cost you to generate a call.
Exactly.
And then you disperse it through,
Right.
your base of advertisers.
So based on their budget, we determine how many calls we need to generate for them, and then our algorithm, what it does, or our IP tries to do that at the lowest possible cost.
So you're just doing paid search, or are you doing?
It's just paid search. Organic does come into the mix after a client has been with us for a few months, as it naturally does, and that actually lowers our cost basis substantially.
So I buy a word toothache.
Okay.
And I'm a user. I look at toothache. I'll come to your ad. Or is it an ad for you, or is it an ad for that particular dentist?
It's an ad for the specific client.
Okay, so you've got, and obviously some ads. So do you have an optimization algorithm similar to Google's, where you're going to put the ad that maximizes your revenue? Because some ads are better than others, right? So you get click rates.
Right.
Do you have that sort of dynamic going on?
So what we're trying to do is measure which ads are going to generate the highest conversion rate on the back end, what is actually going to result in a phone call at the with the highest probability. Now, what happens is when we get deep into verticals where we've signed 7, 8 dentists in a specific market, what we will do is essentially share the ad space and put 2 dentists on one, thereby lowering our cost basis on one page. Does that make sense? So we've really maxed that out because we don't want to take away from the individual business, but we think 2 to 3 businesses on one page will.
So your value proposition, you're always going to be better than that dentist at figuring out how to play the Google game.
Well, one, he doesn't have enough time to do that. He's busy cleaning teeth, and 2, we have to know how on his industry and the automation to make this pretty seamless for him and work.
Okay, so go ahead.
So the technology and really how do we eliminate this risk is a key question. As we just talked about, we have a proprietary bidding algorithm that works and optimizes the budgets of our clients or of our costs, really. These are dynamic markets, and we can continually update our bids on different keywords and search engines. Really, we have a growing data set that we can leverage to help achieve superior returns, and we have data mining capabilities, what they call learned targeting, which not only looks at the keyword, but also looks at the geographic area of the searcher based on their IP address. Again, analyzes the queries or what we call keywords, the time, so we can do different time and day segmentation based on the response rate, and then the refer. Are we going to use Yahoo, Google, AOL, etc. This technology really results in a superior cost structure and a compelling risk-free pricing that we can offer. Marketing and sales. Really, one reason, or the main reason that local businesses have not been, the local market has not been penetrated, there is no local channel right now really to tap into that. They're difficult to somewhat acquire by the main players from a top-down approach. So what strategy that we found has worked pretty well is actually a bottom-up approach by putting in a sales team into a market for, say, 6 to 8 weeks and acquiring a good amount of clients in the vertical. And this is coupled with telesales and referral network to supplement growth. So what happens is, this is really sales strategy, but we're setting appointments before the team gets in there. We're only focusing on core target, densely populated areas, so there's low transaction costs, and then the outside sales team goes from client to client to sell. There's also online distribution that we're utilizing. Now as our system becomes more advanced, we'd like to really drive people to our sites to sign up and that way. And then lastly, there's agencies and affiliates that we can utilize and sell our technology to in licensing or revenue share. The competition, there's two main players in this market. One is ReachLocal, both are well-financed, and Leads.com. Reach has about $7 million in venture financing from Vantage Point. They actually don't have their own intellectual property. They're actually licensing that from a third party called Fisher Frontier. What they do have is some reverse proxy technology that allows them to quickly provide tracking on client sites. What they're doing though is they're using private label branding to really grow their client base. Really, this is, we feel, a disadvantage for them. And while it does achieve decent scale in the short term, in the long term, we think that that's going to be a disadvantage to them. Secondly, Leads.com is spun off by website pros, and they have no real intellectual property per se, but they have deep industry partnerships that allow them to access.
What is an example of what? What do you mean by deep industry partnerships?
So they have contacts at Yahoo, they have a distribution deal with Yahoo Local to place advertisements, essentially.
Now, have they filed their S1?
I think they're the process of filing the S1.
So you don't know the financials yet?
Yeah. So the team, there's myself, I am currently a senior at Penn, took this semester off to really focus on the business, concentration in finance and management, 3 years of experience in the local market, really understanding lead generation and local internet advertising. We're a professor here at Penn who really focused on search advertising, and that's his core research area. We've developed this intellectual property that we're going to be utilizing. Ben Rubenstein, a recent Penn grad, now in the DC office and growing the sales base pretty rapidly. We see about 100% sales growth in this quarter alone. And then an advisor who can become CEO, COO, business salary, experience operating.
You've been at this for 3 years? Started company 3 years ago?
No, the company we started operating last summer.
Okay.
So it was kind of an ideation phase for about 6 to 12 months before. So in summary, this is a growing, protected $10 billion market, we believe, with defensible IP and superior cost structure and revenue. Demand has been proven with about a $450,000 run rate in a relatively short sales period. So we've about $5 million in investment. Primarily, this will go to adaptation commercialization and aggressively beginning to roll out and working with distribution groups such as online and partnerships. We're going to reach capital positive within about 22 months. As really, we've been generating revenue already in our capital neutral right now. And we see like within at least 60 months is an interesting hot space. There's a lot of consolidation in this space, and there's growing demand, obviously, for web services and search at the local level. Risks, we have pricing risk in the sense that the underlying cost structure, the calls, is variable and dynamic.
So take me through, so going back to that dentist, what sort of revenue would a typical customer generate for you?
So really what we've segmented our clients based on, and we have stationary businesses. We're centrally located, they actually have an office. And then second, we have mobile businesses, which are your movers, your tradesmen, your electricians. The trades and mobile businesses are somewhat difficult to contact, and it's not cost efficient for us to go on the ground to them. So we're really targeting them over the phone. Sales, and the price point on them is around $300 to $400 a month. And the stationary businesses, the professionals, the lawyers, plastic surgeons, dentists, we're looking at around $800 to anywhere up to about $1,500 a month.
And so your revenues now are about $500,000 run rate. If I average that to $500 a month, that'd be about 80 customers.
Right.
And if you took those 80 customers, how would they segment? I mean, what are your top 2 or 3 segments you're seeing the most success? What are your top 1 segment seeing the most success? What do you hold up as the example of everything's working?
In terms of gross margins, or is that?
I'd say traction. I'd say revenue, revenue, retention.
Mm-hmm.
Yeah.
We've seen that cosmetics have worked well. Cosmetic dentists, plastic surgeons. There's a lot of people we call inventory online, a lot of search demand. that's available at a relatively low cost.
So they generate, let's say, $1,000 a month. What are you spending to get them a call?
Spending to get them a call.
And what's your-
Right now we're shooting for about 50% gross.
Sorry, what is it?
About 50% gross margins. We think that we can improve that after we implement a little more robust data mining and these
Okay, and all that cost is going into paid search.
for the most part, right.
And what's your cost for adding that customer?
The cost per acquisition is about 30% of the first month's budget on average. So we're looking at around, for a $1,000 client, spending around $300.
What's your retention like?
We're seeing about, I'd say year over year, we're seeing about 85%.
On an annual basis?
Yeah,
So your fall off on a month-to-month is only about 1%?
1 to 2%, right.
We only have 80 customers, so
We only lost a couple.
one, right?
That's what we're shooting for. You know, it's no customer service operation, no brand equity,
Right.
not the full product on yet. It's a little rough around the edges right now. So a little investment could help.
I mean, this is clearly a big market. Everybody's trying to figure this out.
Right.
And you're going after, not even medium-sized businesses, you're going after very small businesses, which traditionally are very expensive to sort of get and maintain. And, you know, the big question I've had that pops out at me is your gross margins on the leads are about 50%. But, you know, you can make the argument that's going to fall pretty quickly, too, because right now, there's a big arbitrage between the value of keywords and what people are paying for them. It's more like a financial market, right? I mean, keyword will get bid to whatever its highest marginal return would be. And so the game that companies like yours play, particularly these folks, I mean, you have to assume you're going to be the highest marginal use of that. You're going to pay the highest marginal cost for that keyword. So if you're essentially buying a keyword for $1 and it's really worth $2, because someone's paying you $2 to buy that keyword for $1, what happens when that keyword becomes $1.50, $2, $2.50? Because someone else wants those keywords, it's worth more to them
Right.
to buy.
And for that, I'd like to go back to
I'm just thinking.
well, one, the technology, right? That's that optimization algorithm and that data set and the industry know-how is going to really allow us to provide superior returns. And secondly, this tail is only getting longer. As users become more sophisticated in their search queries, the queries are getting longer and longer, which provides really an unlimited amount of actual keywords to bid on. So the key is really understanding what are people looking for, when are they looking for it, and having the intelligence and the statistics behind that to achieve a phone call. You know, this Philadelphia cosmetic dentist is the keyword today. Last year it was the keyword dentist, and in 18, 20, 24 months from now, it could be, you know, South Street Philadelphia dentist, and with availability, or you know, who went to. It's getting longer and longer. This keyword and keyword analysis. So as the keyword set grows, the opportunity to really aggregate this area and make you know, decent margins from it is even higher. And secondly, the relevancy of our ads only improves the search engine's results, which they actually, you know, are designed to really accommodate. So what we find is after we've had an advertiser up for 3 to 4 months and you've really learned how to target their business online and find the most relevant searchers, our cost per click of that account is actually dropping every month. Now, if you're bidding on, you know, a higher end keyword and you have every you know, lead generator, SMB trying to bid on that, you will experience margin erosion. But over time, the data set that we have and the ability to fine-tune these campaigns, not only based on keywords, but on search engine, AdSense breaking off, that's going to put pressure on margins. I mean, they're fighting it out on their end as well. So we believe that will be providing decent margins ongoing. Secondly, the pay-per-call aspect does allow us to utilize other means of traffic generation. As you mentioned before, organic search, directory search. And
But how are you doing your organic search? The landing page is your customer, right? You're not.
it is when we're very, I guess, We haven't really penetrated that market in a major way. But after we've gone, we've acquired 10, 15 clients in a given area. There's not enough room on the major search engines to put them all there. So what we do is we diversify their spend and put them on a dual page where basically there's an intermediary page that we're buying, and then
How do you do, because one way a lot of these companies are keeping their cost per customer down is by exploiting organic search. And I'm not sure how you do that. I mean, you're really having to pay for every customer.
for every end user, every consumer.
To find them, yeah, because I don't see how you would.
Well, we own the web property, right? So we can do any type of organic optimization to that as we want.
So you're the landing page.
Right.
Yeah, I think it'd be great to see. I mean, you've been at this for 9 months, I guess.
Yeah.
About 9 months. You must have some pretty good data on what's working, what's not working. I mean, what surprised you in the last 9 months?
What has surprised us in the last 9 months? Well, one, the growth in inventory, the actual growth in online search, and you see we're seeing it increase by 10% for the dental market, month over month. The actual
10% in terms of traffic.
number of people actually searching online. Right now they say that about 1/3 of people are going online to search for information, like all of you are. All the demographics, obviously not, but that 2/3 are still going to the yellow pages. They're transitioning over at ever faster rates as they get more adept and familiar with using search. That's probably.
What about your own business model? What's
So from a business model perspective, it was what we realized is that as we're going deeper into markets, our margins were actually eroding because we were actually increasing the competition amongst ourselves.
Yeah, you're driving up the price.
Right. So until we really have sophisticated technology that can manage that and actually use that to our advantage by getting more people into our network and manage those bids in a sophisticated way, we see an opportunity in the pay-per-call market or pay-per-lead market, because then we're not just so dependent on only Google or only Yahoo to generate traffic. There's a number of other web properties that we can utilize. And then secondly, we can also utilize these what we call adverpages, which is splitting up the landing page among two or three clients, and then thereby diversifying our cost basis.
So what's your capacity? If I said Dentist Philadelphia, what would be your capacity that you can manage? I mean, how many do you get, and then you're sort of done with that category and move to the next category?
In terms of clients, we're looking at about 10 clients right now, and
So-
as inventory increases, we can go deeper into that market.
Right.
And as we have more distribution partners, we can go deeper into that market. Like AdSense is breaking off, or Microsoft is setting up their own ad distribution network. They have an API for that. We would tap into that and then be able to distribute to them. Super pages, writing super pages, is another property that we do.
So Dentist Philadelphia for you would be about $100,000 a year business if you maxed out at 10 and paid anybody $100 a month.
So that would be 8,000. Right.
Right.
Up to 20,000.
Cost you $50,000 to buy those words. Yeah, I think the biggest problem I have is that your segments are so small, and which means you've got to have a lot of segments. You've got to scale across a lot of geographies. And it's probably easier to scale across geographies because that's probably perfectly replicable.
Right.
Dentists in Washington aren't probably that much different than dentists in Philadelphia. So your top 20, let's say your top 20 markets is going to be 95% of your business.
Right.
So the entire market for dentists is $2 million a year. So the math. And so if you have 10 categories, you're at 20 million. And maybe, so the question for me would be two things. One is scale. Two is your cost structure, whether it's sustainable. I think what's attractive about it is you're selling to customers that, what's attractive and scary about it is you're selling to customers that will never do this on their own.
Right.
I mean, the tools will never be good enough that Joe Dennis is going to get up there and figure out a whole search strategy. In fact, the large companies can't even do it.
Right.
There's a big, huge market of companies going in and attacking, $1 million a year budgets and winning. So that's good. It's also bad because they're hard to sell. If you have to figure out a selling strategy that works, since you're doing it on a pay-per-call, you can probably just get people to try it.
Pretty
But
good.
the other thing is you're asking people to, if I understand it right, you're saying to Dennis, okay, pay me $800 a month and I'll bring you calls as opposed to pay me $20 a call. So they're sort of committing to a subscription model. And why did you do that? As opposed to signing up somebody and saying, hey, I'll pay, it's $25 for a call.
So the budget is somewhat variable because at the end of the month, we don't achieve 40 calls. That budget will roll over. We do like to kind of standardize it, and from a billing standpoint, for small business, really they don't understand receiving 35 charging as a credit card 1 month. That's
Right, that's probably how they're paying for Yellow Pages, right?
Right.
Some of that. So why does someone say no?
Why does somebody say no? Well, our appointment close rate is probably around 75%. So when you get time with them, the close is pretty.
If you only have 80 customers, what are you doing for 9 months?
It's not easy to manage these things like technology. So I'm talking to you.
Well, it has to be tough. I mean, you have 80 customers. It has to be tough.
Prospecting can be a little bit difficult.
Once you get the appointment.
Right.
Yeah, I mean, I think the other challenge is, I mean, these businesses tend to be sort of increasing returns businesses. So what we like to see is, hey, I looked at a company the other day, there are 20,000 banks. They have 1,200 of them for their application. So it's much easier to sell the 1,200 first than the first, right? Because it sort of creates a critical mass and they start to dominate that niche. But if you're maxing out at 10 dentists, it's hard. It's going to be hard for you to benefit from that sort of economic thing. Because ideally, you want a business that says, I get every single dentist in Philadelphia automatically, if they want to be in business, signs up with NetPow. We're also not going to get any leads.
Right.
You know, but you seem to top out pretty low.
Well, then,
There are
that's
1,000 dentists in Philadelphia.
right. I mean, they can't all spend the same amount and have the same returns, right? But there is an opportunity to move into the outskirts of the cities. You know, as I said, search demand is only increasing.
But the Yellow Pages works because every dentist has to be in the Yellow Pages. If they had 10 dentists, the whole business almost falls apart. The economics would be that different from the Yellow Pages. So,
I mean, the way we're looking at it from a customer breakdown is about 20. There's no reason that taxation, because it can't be used with yourself technology, really can't apply to many more than 20 businesses or 20 categories. So
so it's 20 categories, and that's $40 million market.
if it's 20 categories,
I'm doing my math right.
we're looking at about a $50 million top line. That's kind of first stage.
Okay.
20 categories, about 20 markets. A huge data set. It's immensely valuable.
Well, Philadelphia is 6% of the U.S. population, I think. Is that right? No, it's not that high. It's about 3 million people here. It's about 1.5% of the whole market. And I don't know, probably 50% of the market's in the top 25 MSAs.
Right. Our company is somewhat higher and more tech savvy.
Right. We're not tech savvy here.
We're getting there. We're getting there.
So if you assume Philadelphia is, say, 3% of the total market, then, you know, you could get to 2 million here, you're talking about a $60 million market. So what's the exit? You know, how do you know?
Well, I mean, in terms of the focus on the local market, there will be an online distribution channel, which you get a lot of somewhat unconventional businesses, I guess, working with you. Cottage industries, you know, we have, you know, an eBay auction company that's working with us. We would never sign them up with a little PR. People are coming to our website, they've signed up online. So, yes, this is the go-to-market strategy, but is that the cap on the market size? No, the Yellow Page market is a $15 billion market, and the majority of that is going to move online. You know, how do we exactly target businesses in the suburbs? That's something that the technology will adapt to, and as users become more accustomed to doing that, it will increase. So, in terms of $800 is our price point, because we can afford that to go to Southville, right? And that's what we need to warrant our costs. But really, we could have 200, 300, $400 clients as well who are attracted to general advertising, marketing, trade shows, and so on and so forth.
So what are you going to do with the $5 million, and what are the uses of capital?
So it's going into increasing our technology budget, hiring more developers to commercialize this intellectual property. It's going to really start rolling this out into more markets and more metros. Development online, the online infrastructure, that's necessary to really sign people up automatically. There's a lot of back office processes that can just be automated.